So let's give a very warm welcome to Lee Goldberg of BD Insurance Marketing. Hey.
Can I take this off of here? Good morning, everybody. We've had a lot of content to tick and all that. So for the next 6 or 7 hours, we'll talk about insurance, and I know everyone's looking forward to that, so I can't wait to share all of this with you. I was asked to wear this Muppet microphone, so hopefully you're picking up on your end as well. So good morning, everyone. My name is Lee Goldberg. I'm an independent insurance agent. Oh, sorry. I jumped the gun. I always want to talk about myself, and I don't ever want to talk about anyone else. Before we get started, I did want to take a moment, just like before me, and congratulate you for really differentiating yourself among your peers and choosing to align yourself with a NAR-affiliated state, whether that's Georgia or Alabama or visiting from anywhere else. You really do stand out among your peers by enforcing the standards and rules and regulations and policies and procedures associated with running an excellent recovery residence program. So I did want to take that moment and acknowledge everyone. Also, insurance is extremely boring. I understand where I stand in the food chain, and I understand that I am a vendor to what you do, but it's important. You don't want to miss anything, especially if I tell one of my 3 jokes, and pick someone around you to wake you up if you start snoozing off. But I promise I will do my absolute best to be as interesting as possible, because I love this topic, and I hope you will too by the end of this morning. So I am an independent insurance agent. I've been an insurance agent for 16 years. I currently insure about 20,000 events across the country. That's in 30 or so states. And I directly assist and wrote the insurance requirements and assisted in training the field assessors in Florida, Georgia, South Carolina, Virginia, West Virginia, Pennsylvania, Connecticut. Connecticut's kind of its own thing now, Oklahoma, Kentucky, Ohio, Colorado, and Washington. So those are the states we work directly with the state affiliates with. Not all insurance is the same, as I'm sure everyone in this has come to realize. Main Street businesses are easy to insure. Behavioral health care, substance use treatment, recovery residences are not. And all insurance agents want to help you. When insurance agents first hatch out of their egg, the first lesson that they're taught is say yes to absolutely everyone that walks into your office. You can help anyone, you can insure everyone. Unfortunately, not all are capable of doing so. And not understanding the nuance of any one particular industry is extraordinarily dangerous for the policyholder, which in this case is yourselves in the room. So we're going to talk about 2 topics today. I feel like everyone's over here and this whole side of the room is getting neglected. I'll hover over on this side for a little bit, give you guys some love on this side. So insurance and risk management oftentimes gets bundled into the same discussion. However, they are 2 very distinct topics of discussion. And I wanted to take the time to differentiate those 2 items for you, because risk management is really one of those efforts that takes place on your side, on the operator side of the transaction. So first off, insurance. Insurance is the practice of risk transfer. You are paying a premium, the cost of your insurance policy, to transfer your risk, meaning the cost of your future problem, to somebody else. And in your case, it's the insurance carrier. It doesn't prevent your problem from happening, and it doesn't make the problem go away. What it does is cover some or most of the costs associated with the problem that you experienced for your business. And for what can be insured, it should be insured well. And everything is not insurable. The practice of risk management is about a mile long, is the analogy that I like to utilize. And insurance is really only a quarter of that. So buying insurance does not solve all of your problems. Best practices is the way that you mitigate as many problems that you possibly can and that you might experience. And Candace did an amazing job. A lot of the topics she brought up is going to be overlapping. We probably should have coordinated better. That's my fault. So now on the other side, risk management has a number of components. One is the financing of risks or spending money to prevent the issue from happening in the first place. Being proactive, being preventative, controlling it, insurance, which is the small component of it. And risk management is really for all of the bad things that can happen that are not insurable. And we're going to go a little bit deeper on all of that so you don't have to retain and remember it. Also, there's nothing proprietary in my slides, so you're welcome to take pictures, but we can also email them to you. So don't feel like you have to take copious notes. The test at the end is only like 125 questions, and I grade very loosely, and there's only one essay part. So you are already risk managers now that I freaked everybody out a little bit. Driving a car, especially here in the South. I didn't mention I'm from Asheville, North Carolina. My main office is in Fort Lauderdale, Florida. There's crazy drivers everywhere in the country, but what I don't understand living in the South, I live in Appalachia, there's some rural components of Georgia and Alabama certainly. How is the speed limit on these 2-lane back roads 55 miles per hour? I want to drive on the grass with my hazards on. I'm petrified, especially at night. Nothing's lit. I don't know how everyone drives, even though it's just the speed limit. So driving a car, managing risk, deciding to buckle your seatbelt, checking if you have tread on your tires before the winter. We get some ice storms here in Atlanta. It's on national news every time it happens. Asking someone out on a date, the answer could be yes, which is sometimes just as bad as the answer being no. Buying organic produce versus regular produce, ordering dessert knowing you're going to have to do some extra jump ropes at the gym the next morning, shopping online because the shoe size is never right and you're going to have to go and return it anyway. Going to bed late knowing you have to wake up early, having children, or simply going on a walk. Having children is tough for me. I have 2 boys, 14 and 12 now. And with the first one, I was the worst helicopter parent. I don't know if anyone else was the same way. When I was trying to teach him how to ride a bike, I would run alongside him, and as he started to tip over, I would lift him up off the bike so he wouldn't hit the ground. And then when my younger son said he wanted to take his training wheels off of his bike, I just pointed him downhill and figured he'd be okay, and he was, and now he rides a bike. So you live and you learn how to manage risk as you evolve and grow as an individual. So again, you are all already risk managers. It's not on the front of your mind, but you're constantly calculating the risks that you encounter day to day. So on the business side of things, these are some examples of risk management. Am I too far close to the microphone? Is this working for everybody here? It's real loud for me. Just wanted to make sure I wasn't blowing everyone's ears out. Wanted to manage the risks. So one subsegment is catastrophes, hurricanes, floods, fires. What can you do? You have no control over those things occurring, especially if they're derived from nature. But what can you do to have a continuation of business is really how you need to think about risk management from a natural catastrophe perspective. So can you have a peer location? We advise a lot of our clients to call a friendly competitor, someone you might say, I know we don't consider ourselves competitors in this segment, but another business that is not your business, that's within 1 or 2 hours of yourself. And you say, hey, I run a recovery residence here. And if something happens to our property, we all know that sending residents home is not the best solution. Displacing them, putting them out on the street is not the solution. Could you accommodate us? Could you donate some beds? Could we come up with a rent share opportunity so we can move our residents over to your location until we can rebuild our property? Something just as good as a peer location is a hotel contract. You call a hotel within an hour or 2. The reason I say hour or 2 is because if your location is physically damaged by flood, fire, or hurricane, chances are your neighbor across the street is going to be. So it needs to be a distance that's reachable, but is far enough away where they might not have been as directly impacted. Okay, so a hotel contract, you call up a local Holiday Inn, you say, hey, can you hold 5 rooms for me during June 1st to November 30th? And if you have to fill them, you can fill them, but I'm happy to pay you a marginal fee so that you can hold those rooms for me on a consistent basis, just in case we need them. Or just an alternate location altogether. Of course, you'd have to check with zoning, but can your license be transferred to another location on a temporary basis? That's more challenging if you're providing residential levels of care, like ASAM 3.1 up through 3.7. But from a recovery residence perspective, can you move displaced residents to another location temporarily? Regulatory. Your rental agreement that you have with your residents, you need to have your attorney review, you need to have assistance from your state affiliate review. Are there new laws that are preventing you from opening in any particular area? And that ties in zoning. In South Florida, about a year or two ago, in Palm Beach County, there was a singular city within the county that passed a zoning law that said, you can absolutely have recovery residences. We love recovery residences. There's nothing wrong with recovery residences. We'd love to have you in our city, but you can't have more than one next door to each other. And we had a client that had 5 houses all on one street, all next door to each other. There was a continuation. They shared vehicles. They shared swimming pools. Everything was great because they were all together. It was unfortunate because the operator had to sell every other house because they couldn't have more than one next door to each other. It had to be sober home, not sober home, not sober home. So zoning, just be aware of it, know what's coming down the line, show up to your county meetings, your municipality meetings, provide some input if you feel like you need to. Financially, tax implications, speak to your accountant. I'm way outside of my lane here because I am not an accountant. However, in particular areas, cities specifically, they tend to be more coastal cities that have a high rate of tourism. Short-term rentals have to pay an additional hospitality tax. So the Airbnbs, hotels, you get that extra line on your receipt when you check out when you're at a beach resort. It says hospitality tax. It's because you're in a tourism city and a lot of their additional revenue is derived from that tourism tax. So again, talk to your accountant. Don't take my word for gospel, but my understanding is if you write your rental agreements with your residents that are for 7 months and 1 day, even if you're not enforcing it, if a resident leaves after a week or two, you're not enforcing the length of your lease, but you could potentially not be subject to that hospitality tax. So it's just something to be aware of if you're impacted in your local community or where your program is based. The economy. If there's a downturn in economy and service jobs and trade jobs become unavailable, are your residents going to be able to pay rent? Or is it going to turn into a scholarship quarter for you? And the government involvement. Some states, Ohio, Indiana, some other in the Midwest are now creating an additional income stream or licensing level for recovery residences that are called respite houses, where you can now bill Medicare, Medicaid, or for the rents associated. Is that coming your way? I don't know. You'll have to speak with your local state representatives for that. So just these are all things to be on top of. And then the final component is transfer. Insurance is a way to transfer your risk. It's the most common one. It's a NAR requirement. It's a GAR requirement. Escrow. Are your rents coming directly into your LLC, or do you have a separate holding entity that won't be subject to a lawsuit because they hold no liability? Do you transfer your rents back out through a management company? Again, these are lawyer and accounting questions, again, to create layers to protect your business and ensure there's longevity. And then your corporate structure. Are you operating as a sole proprietor, a 501c3 nonprofit corporation, LLC corporation, whatever? I suggest not operating as an individual because all of your personal assets are exposed in that circumstance. And I don't want to go down a rabbit hole, but if you own the real estate, I strongly suggest there's a rental agreement between the real estate entity, or if you own the real estate in your personal name, and the operating entity, with mutual indemnification language so that your asset, the physical property, is going to be protected, and any type of liability event is exclusively isolated to the operating entity that's inside of the house you own. If I lost you, I'm sorry, I kind of went on a tangent there. Tell me if I need to repeat anything, and feel free to jump in and ask questions. If it's hyper specific to you, let's chat after. If you feel like it could benefit the entire room, then feel free to throw questions at me. This segment, I speak in a number of states across the country, including the national event. And there's way more questions than I ever suspected there would be. I always thought, who the heck wants to hear about insurance for an hour? So after I freaked you out again for a second time with risk management and insurance, this is a quote that's 100+ years old that I think is extremely important, and that is, a ship in harbor is safe, but that is not what ships are built for. If you want to be completely absolved from risk, just close your business and stop doing it. No one's asking you to do that. You need to understand that running any type of business is going to create some form of public liability and risk for yourself. I'm providing you with some solutions here on how to mitigate that or make that exposure as small as possible so that you can continue to provide the excellent care to the community that you chose to provide. So what is insurance? This is a history lesson, so if you're going to sleep, sleep now, and then I'll wake you up in about 5 minutes, okay? Insurance is nothing new. Insurance came about, the insurance that we know, that we think of as insurance, commercial insurance, homeowners insurance, auto insurance, it came about when the Eastern colonies were being developed back in the late 1600s, early 1700s. And it was derived from a coffee shop. And the owner of the coffee shop's name was Edward Lloyd. I'm sure everyone has now heard of Lloyd's of London, which is the global insurer and financial institution. It's the entity that insures Mariah Carey's voice and this and that. Lloyd's of London is the massive insurance entity where all money flows. But it all started at a coffee shop owned by a guy named Edward Lloyd. And the merchants that would sell items to the colonies would congregate there, because it was right down on the docks of London. And it might be Lee's shovels, and it might be Tom's hats, and it might be Sarah's buckets. It didn't matter, because you would take all of your life savings, you would buy a bunch of stuff that was needed, you would put it on a ship, and then you wouldn't hear anything for 2 or 3 years. Hopefully some money came back someday. Well, the shipping channels, much like today, were the same as they were then. So ships would pass each other, and they would yell out, "Hey, I'm carrying Lee's hats, and I'm carrying Tom's shovel, or I just delivered Tom's shovels, and now I'm coming back." So this was the news center. Rick Lloyd's coffee shop was the news center for everyone. Edward Lloyd had an idea, and he said, "Oh, if Lee's ship goes down, he's losing all of his shovels, he's not getting paid, and for the next 2 generations, his family's going to be poor. Is there a solution for this?" And the solution he came up with was that he put a jar on the bar, the barista bar. I think they were calling them baristas then. But they put it up on the bar, and they said, "Anyone who wants to support each other, you buy a wooden nickel from me. Every time you buy a wooden nickel from me, I'll put it in the jar. And if one of our friends loses their ship, they get the jar of wooden nickels, and I'll exchange that for the money that you bought it for." And that became the sharing of risk. Everyone, all the merchants chipped in, and they said, "Hey, if you lose your vessel, you lose your ship, we'll all chip in." But they're chipping in proactively. Well, the financial markets in London started hearing about this, so they put up a chalkboard, and they would write Lee shovels, and a bunch of finance people would take bets. They're like, "I know who built that ship. My grandfather built that ship. That's a good ship. That ship's made the passage 5 or 6 times. I trust that that ship's going to be back. I'll take that bet." And they would write their name underneath my name, which is where you get the term underwriter from. I'm sure everyone's had that term underwriter. It literally came from one person writing their name underneath somebody else's name. And then it just turned into this enormous financial market and transaction. But what insurance was, and what insurance remains, is the premium of the many cover the losses of the few. Your insurance policies in this room, from a liability perspective only, you're carrying $1 million of insurance, plus the cost to defend your case, and you are not paying anywhere near $1 million for that $1 million in coverage. So if everyone in this room all has a policy, and the amount that you pay, based on the size of this room, I don't suspect would add up to $1 million. So even if one person in this room had a policy limit claim, meaning paid out $1 million, the insurance carrier would still be in the hole. Insurance carriers, the insurance industry, from what I hear, again, I'm on the inside, so I don't know what you guys are saying about it, but they don't have a good reputation because they think they're sitting on all this money and they never pay claims. Insurance carriers pay out 99% of every dollar they bring in. Okay, so their loss ratio, insurance carriers make their money while they're sitting on the money. They're earning interest on it. They're making investment. They don't actually make money off of the premium. They're paying out 99 cents on every dollar because of what I just said. Everyone in this room's insurance premium would not cover $1 million loss. So this, I think, is what everyone really came to hear about. I just do a 34-minute warm-up so that these are easy and everyone's just worn out by the time I get to this. So these are the coverage. This is what you should be looking for in your insurance policy. These are the questions you should be asking of your insurance agent, okay? The primary coverage that you need to have as a recovery residence operator or any business owner for that matter, whether you're a landscaper, you own a barber shop or a bakery or a sandwich shop, it doesn't matter, general liability insurance. And general liability insurance is the only and primary requirement of NAR, the National Alliance of Recovery Residences, that requirement trickles down through all of the state affiliates, GAR, and how do we pronounce Alabama? R. Oh, I should have had a joke. I was talking about ships. I could have done a pirate joke at that point. Okay. Lost opportunity. Okay, so general liability. I'm going to start to get real nerdy. Tell me if I'm losing anyone. General liability covers primarily one thing, that bodily injury to a third party arising from your negligence. And what that means in English is people you hurt because of a mistake that you made. Cut fingers in the kitchen because the knives are too sharp, falling down the stairs because they're too steep or too slippery, slipping in the bathroom because you didn't have a bath mat down. That's what general liability is. It's bodily injury because you made a mistake. Okay, that's really the whole foundation. Homeowners insurance is not appropriate for a recovery residence for a multiple of reasons. The first one being you are a business. You are not a house. Okay, you happen to be operating your business inside of a house. I don't know if anybody grown up in like old school, like Philadelphia or Baltimore. I see a guy over there with a Sixers hat. I don't know if you're originally from Philly, but like on the corner of Northeast Philadelphia, you have like a physician's office and it's inside of a house. And like somebody lives above it, but a homeowner's policy isn't going to cover your doctor or your dentist that happens to be on the first floor of this 2 or 3 story brick building that's on the corner of a city. So you're running a business. A homeowner's policy is meant for an owner-occupied dwelling or a house that you are renting to a single group of related individuals. The insurance industry refers to group homes as having transient residents. And that's the definition that they came up with, but that just means a group of people that aren't related. I understand that the ADA and NAR and myself, we understand that living together for the reason of overcoming a disease and in a peer supportive environment and supporting each other is acceptable and has excellent outcomes and is what needs to be done. This is why recovery residences exist. But homeowners policies were not written, designed, and don't have the coverages appropriate for this. So like homeowners policies don't want to be insuring boarding houses, dormitories, assisted living facilities, and recovery residences fall underneath that umbrella of ineligible classifications. Some of the common exclusions that you need to look for on your general liability policy when you leave this meeting today, or you can call up your insurance agent and say, hey, do I have an abuse and molestation exclusion on my general liability policy? That's what the A&M stands for. Do I have an assault and battery exclusion on my general liability policy? That means you have no coverage for fighting. And is my coverage only limited to my premises? EREM stands for. Those are the 3 most common things I see on insurance policies that were not really designed for what you do. The reason is abuse and molestation occurs more often than you would think. Assault and battery, fights happen. Oftentimes it doesn't result in a lawsuit, but it still occurs. And if there's a lawsuit, you want your policy to be able to cover your legal expenses and pay damages. And then the premises. As long as your residents don't leave the 4 walls of the sober home, then that's fine that you have your coverage limited to the address on the policy. But if you make referrals to programs outside, if you take them to the beach, take them bowling, take them to the movies, do any type of activities at the park, go to baseball games, anything, that means that once they leave the driveway, coverage stops on your insurance policy. So those are the three things that I suggest, because when you get your insurance policy from your insurance agent, be honest with me. Do you read past the second page where the insurance premium is? Once it says cost? No, you don't go past that. This is what the rest of the pages are for. The other 86 pages, it's telling you what it's not covering. So I'm telling you to flow through it. If it's in a PDF, just hit Control F, abuse, Control F, assault, Control F, premise. You can just search for the words as long as it's in a PDF. If it's printed, you're gonna have to read it. And just keep it on your bedstand, because that'll help you go to sleep. Abuse and molestation is exactly what it sounds like, and the main response that I get when I talk about abuse and molestation coverage is, well, it's single gender housing. I have an all men's house. I have an all women's house. This doesn't matter. It doesn't matter until you have a guest or until your residents are out in the public. If you have a group of gentlemen that are enjoying their vapes or cigarettes on the front porch and they happen to whistle at an attractive individual of the opposite sex walking down the street, and it turns out she got off of a school bus around the corner, and then dad comes running over and an altercation ensues, that's abuse and molestation. It doesn't need to be resident on resident in order for this coverage this exposure to exist. Be aware of that. Professional liability. This is not a requirement of NAR, nor of anyone. This is a business decision that you have to make. So I have some giveaways back there, just a few, but they're really cool. They're back scratchers, and they say getting me back to this. So I'll give them out to whomever can answer. What did we say general liability covers? What's the main thing that it covers? Bodily injury arising from what? Negligence, thank you. I heard negligence here. I have more than just like two, so if you feel like you said negligence, come accost me afterwards and I'll get you back. If you are a non-clinical provider and there's an overdose in the house, you can't be negligent for the outcome of that overdose. But that doesn't mean the family is not going to sue you of the survivors of the family. It doesn't mean they're not going to sue you just because you're not negligent. Okay, they're going to sue you because they lost their loved one. And we know that you've done everything you possibly could, and they got drug tested by their parole officer on Tuesday, and they decided to celebrate by not waking up on Wednesday. And I'm sorry if I'm coming across jaded, we get a call a week about somebody passing away in a recovery home. It's really unfortunate, but when you have a scope of 20,000 beds, you see a lot. So professional liability covers wrongful acts or the failure to perform the duty you were compensated to perform. And if your website or your brochure or your outreach coordinator or your administrator or your intake personnel says, we provide a safe, sober living environment, which you intend to do is provide a safe, sober living environment. But if somebody doesn't wake up one day because they were using in your house, you failed to provide that duty in the eyes of the court, in the eyes of the surviving family members and the loved ones and the parents and the children of that individual. So the majority of recovery residence operators that we work with elect to choose to carry professional liability because of the reasons I described. Most of the individuals that at some point in time come to us for assistance, it's apparent that they do not carry that coverage because this was never discussed. If there's no takeaway from today other than this, I would strongly advise you call your insurance agent of choice and say, do I have professional liability? If no, why not? Explain to me why I don't need it, and then decide if you want it or not. General liability covers negligence. If you're not a clinical provider, you're not doing cavity searches, you're not a locked door facility, you're not going to be negligent if somebody chooses to go to work, obtain a substance, bring it back into the house, and utilize it. That's not going to trigger negligence. That's a wrongful act. You failed to provide a duty at that point. And I'm using this language. I'm not calling anybody in here failures. Please don't take it that way. I'm using the insurance policy language and how the lawsuit's going to read. Property insurance, there's another quiz coming up here, and unless you sat in on any of my sections at NAR, you wouldn't know the answer, and if you have, then you just get a free back scratcher because you already know the answer. But property insurance covers three things for the most part. Again, we're doing high-level stuff here. Building coverage, contents coverage, loss of income. If you own the building or you have a triple net lease, you need to insure the building. If the stuff inside your house is of any value to you, you want to insure it. If it's all donated or IKEA furniture and you don't care if it burns down or blows away, don't carry contents insurance. Contents is for stuff. buildings for the building. And then loss of income is the income that you lose, the rent you're unable to collect because there's damage to the property. It has nothing to do with the economy. It has nothing to do with a power outage. It has nothing to do with the road collapsing. There needs to be direct damage to the physical location, and then you can claim loss of income. If the roof peels off and you collect $150 a week per bed and you have 8 beds, you can collect $7,800 a month for as long as it takes you to replace the roof or until your policy runs out. You decide on the limit of coverage that you carry. Two of the insurance carriers that we place a lot of policies with wanted me to discuss what's written in red here. I turned it into a question because it's so ridiculous nobody ever gets it. What are the largest loss in the last 2 years from a property standpoint? What physical claims have been filed the most specifically in recovery residences over the last 2 years and the cause? Anybody have a guess? I'll tell you, you're getting warmer, but you're not going to get that. We're just having fun now. Fire is correct. How did the fire happen? And it's not smoke. Cook. Oh my, you guys need to combine your answers, okay? Come see me after, I'll give you a backstractor, because the answer is cooking your laundry. What's the flattest spot in a recovery residence where someone could fold laundry? The answer is a kitchen counter. And if you're folding your laundry on a kitchen counter, where do you put your white Target plastic laundry basket so it's out of the way so you can fold? You put it on the oven, of course. And if somebody just made macaroni and cheese on the oven, the coils are hot. Correct. Okay, we're getting there. So the baskets melt and the clothes catch fire and the kitchens burn up. I can't make this stuff up. Okay, this has happened enough that insurance carrier says, Lee, if you're going to go speak at 8 different recovery resident events during the year, can you please bring this up for us? Because we paid out so many kitchens because of laundry basket on ovens, on range tops. So if you want to make a red sign that says no laundry baskets in the kitchen, do that. That's risk management, so you don't need to use your insurance. Coming full circle. It's ridiculous, I know. Here's some additional coverages that are important to consider. Again, nothing past the general liability. You're not going to get in trouble from anyone from a regulatory perspective if you don't carry anything other than this. That's the only requirement. The rest is should have. The top one is need to have. So auto insurance. If you own vehicles, you need to insure them commercially. If you own vehicles in the name of the business, don't let your residents drive them. Staff and volunteers and owners. An excellent alternative, if it's available to you, if you ask your insurance agent for it, is something that's called hired and non-owned auto liability. So if you do not own a vehicle in the name of your business, your LLC, your nonprofit, your corporation, I know, and you can shake your head, but I know house managers are driving residents in their personal vehicles. Common. I'm not judging you for it. That's how your business model works. People need to be transported. Midnight pickups at airports. Hey, I just broke up with my boyfriend or girlfriend. I'm thinking about using, can you come scoop me up? I need to get back to the house. I missed my doctor's appointment. I missed the bus. My bicycle tire's flat. I need you to come get me. You're driving your residents. As much as you say that it's prohibited, it's going to happen. So the hired and non-owned auto liability coverage drops down with $1 million worth of coverage and sits on top of the auto insurance of your staff members. Your staff members insured with Geico or Progressive or State Farm or whatever, and they carry the state minimum limits. But if there's an accident, the injured individual, whether that's somebody they hit who's totally unrelated to your program, or the client that's in the vehicle, if they're injured or they roll an ankle getting in and out of the vehicle, it doesn't matter. Their mind says, I was injured by the business. I'm going to sue the business. And so this is the coverage that protects the business for the use of personal vehicles. Think about your local pizza place. Johnny is 16 years old and delivers pizza for a living, makes most of his money off of tips and wants to get there quick so that he can make the most tip possible. Big pizza corporation puts a pizza in Johnny's trunk and he says, hey, you go deliver to Mrs. Smith on 123 Main Street. He's zipping over there, blows through an intersection, causes a whole bunch of damage. Little Is it Jimmy or Johnny? I've already lost track of my analogy here. Johnny's always screwing stuff up. So Johnny causes this big accident. Johnny doesn't have deep pockets. Big pizza company has deep pockets. The big commercial pizza entities that you're thinking of from the commercials with Shaq and whomever else, that entity carries non-owned auto liability. Think about somebody using a vehicle for business that you don't own. It's one of your employees. All businesses do it. You go to the bank, you go to Office Depot, you pick up lunch for a meeting. You're always using vehicles, personal vehicles for your business. Workers' compensation. This one I won't go super deep on because I don't want to run out of time here, but in all states, for the most part, if you have 4 or more employees, some states it's 3 or more W-2 employees, you're required to carry workers' compensation. Workers' compensation is the sole remedy for an injured worker. That means it pays 100% of medical expenses and 2/3 of their average weekly wage if they get hurt while they're working for you, whether that's in a car, hanging a picture, stepping in a hole in the backyard, mowing the lawn, doesn't matter. This is a challenging concept because I expect most operators in this room don't have W-2 employees. You have house managers that are living in the house that don't pay rent. And they're just a senior resident. You rely on them to call you with problems and fix problems if they choose not to call you. Free rent is considered a form of compensation, and therefore they would be able to hold you responsible for their injuries and their lost wages if they were to get hurt while they're working for you, because they're not paying $150 a week to live in your house. Therefore, it's a direct form of compensation. Talk to your agent, your accountant, your attorney about, I don't want to say loopholes, but workarounds so that you can continue to indemnify your business. Could they be considered volunteers? Could they pay $10 a week instead of $200 a week? And then if they get hurt, they fall under the general liability because they're still arrested. There's alternative solutions that really aren't a discussion for a public forum, but for which you can work around and figure out a way that best suits your business if you're, for some reason, not in a position to place workers' compensation coverage to cover your employees while they're working for you. Cyber liability, I believe, is an important coverage for organizations of your size, maybe $1,000 for the year, maybe $1,200 for the year. You're in control of birth dates, social security numbers, payment information, healthcare information, HIPAA protected information. If you're ever alleged to be in violation of that information, the remedy here is to have cyber liability coverage. This is going to defend and indemnify you and monitor credit and send out those letters that you get when your Target card gets stolen, all of that stuff. Employment practices liability, again, we're getting a little bit more upstream from the general exposures you see that are created with independent recovery home operators, but this is when you as a business owner get sued for wrongful termination, age discrimination, any type of discrimination, sexual orientation, race, religion, etc. This is when suits get filed against you by the Equal Employment Opportunity Commission, the EEOC out of Washington. And then directors and officers. This one's important for our nonprofit folks in the room. This protects the board for the decisions they make as a lay leader on behalf of the organization. Hey, nonprofit recovery house, I'm going to donate $10,000 to you. I would like you to use that towards scholarshiping some bed nights so that you can help people in the community before they have a job and they're tilted up and able to work on their own. But you use that $10,000 to put a down payment on a new property and decide to expand, and then the board gets sued because of the decisions they make, because that money was dog-eared for something else. That's an example of what the directors and officers policy is for. If you're a nonprofit and you have a board, you have a duty to protect your board because they're donating their time and their expertise to you. Carry the directors and officers policy. For nonprofit recovery residences in most states, it's like $800 for the year. And that provides $1 million worth of coverage for the board. I wouldn't serve on a board unless I knew there was directors and officers coverage in place, and I've served and serve on a lot of boards. This I'm going to read to you, and we're starting to wrap up here, but not all insurance policies are created equal. If you expect to insure your business the way you intend, it's imperative you adjust your budget to meet the coverage you want and not adjust your coverage to meet your budget. as consumers, myself included, we've all been trained and conditioned to think that the lower premium is best. The little green lizard, the lady in the white apron, we see the commercials constantly fed to us that you can control your insurance premium. As I explained to you how the insurance industry works is you're giving something up if you're going for the bottom dollar. And I'm not telling you to go out and spend $50,000 on insurance, because the difference between something that's poor and something that's manageable or decent or good is hundreds of dollars a year is the difference. You know, we're not talking thousands of dollars a year. The burden is now on you that you have this information to ask the questions of the professionals that you choose to surround yourselves with. Go to your insurance agent. I pay you. You've been my agent for 5 years. Why don't I have this? Can I have this? How much more is it for me to have this? Pick and choose what you want. You are in control of your risk management and insurance strategy. So in conclusion, I always make a point to say, sometimes I say it in the beginning and then this slide's pointless and I just have to say there's a house. But this is not a sales presentation. I am a vendor to your business, but I get asked to speak at these engagements because it is well understood that not only the people in your community don't understand what you do for a living, but most insurance agents don't understand it either. Long-term recovery happens in peer-supported environments. I am passionate about that concept. I understand it deeply, and I know that the hard work that's done in the recovery community, starting at detox, trickling down through PHP, IOP, MAT programs, it happens at your level. It's being performed by the people in this room. So I wanted to make that clear that this is not a sales presentation. Take this information, go to your people and figure out if you're doing it right. And if you're not, what you need to do to make it done right. Okay. And I don't need to be your agent to be a resource. I think I have contact information up here. I don't need to be your agent to answer a question. Be like, hey, I'm jammed up. I really like my person. I don't want to leave my person. Can you remind me like how to ask the right stuff? I'm here to help this community. We're passionate about this. I am available up here for like 5 minutes for any questions, and then we'll be right at 11:30. If you want to speak to me about something very specific, we can do that off to the side. I'm going to hang out for like another hour before I have to get on the road. Sure.
Yeah, what's that? Self-managed, that,
Right.
and, yeah, but it,
Yeah, so different states have different regulations with their insurance carriers. So it's not that the state is excluding it, it's that the affordably priced insurance carrier is excluding it. You can get it, but it's gonna cost twice as much, let's say. I don't know what the exact number is. If you're paying $2,500 a year, and because of court cases and how they were paid in the state of Georgia, insurance carriers are saying, okay, we can't get involved with this one component anymore. We're going to be excluding it. An alternative carrier might be able to offer it, but it might be $5,000 or $7,500 for the year. So then at that point, you'll have to make a business decision to say, okay, like how concerned am I about fighting specifically? Because assault and battery is just fighting. If there's a slip and fall, if there's an overdose, if there's something else, you're still going to have coverage. The one thing that we're talking about being excluded in that circumstance is assault and battery. So that's the fighting stuff. There's nothing to do further. If you feel that that is a coverage that is at your core imperative to have, then we'll talk with Mitch and get you the alternative, and then you can make the business decision to say, like, is it worth tripling this cost in order to have this one component of coverage? Of course. Yes. What does it say?
yes,
That sounds like a carrier code. What are the words that are next to it? Is it a type of, It could be a type of substance that they're excluding. Are you a clinical program as well? Okay. Let's talk about that when I come down. I just want to make sure I can answer any general question.
Yep.
But you're looking at the endorsement section, which is great, which is what I told you to do. The next part to that is that language is going to be defined deeper down in the policy. And it might not be as bad as you think. It might specifically say, we're not covering you if you prescribe this medication, which is not a problem. Everything is not the end of the world. If I misrepresented that, I'm sorry. You're excluded. Okay. Exactly. Yes.
I go back, keep it from the left, the label here is not level 1.
Mm-hmm. You're a higher level of care.
But, yeah, like, each.
If you're a level 4, I would certainly suggest that you're carrying the professional liability. And if you're not, include that. Because level 4, I mean, you're providing professional services you're not even getting paid for. You're helping with resume writing. You're making suggestions for degree completion. You might be making suggestions on what college they attend to get a trade degree. You're hosting AA style meetings in the living room that are disguised as house meetings, but you're really providing some non-clinical but level of counseling there. I mean, you certainly have a professional exposure as a level 4. Level 3, high level 2, 3, and 4, I believe have a professional exposure. Anything above an Oxford House model has a professional liability exposure, in my opinion. Did I miss someone over here? I gave this side so much attention. I just want to make sure. Yes, ma'am.
The picture? Yeah. You suggest the thing if I need?
Let me start with this. If the vehicle's in your name, no one should be driving it except you or a relative. Okay? Do not give your vehicle to managers to drive. The hired and non-owned auto discussion that we had was related to the personal vehicles owned by your house managers. And if you have that coverage, feeling comfortable that they can go out and use their vehicle for business purposes. I'm going to go way off the rails if I go too deep on this, but the short of it is, don't let anybody that is not in your household have access to your keys. Your personal auto policy is going to deny claims, and all of your personal assets that you've accumulated are going to be at risk. I mean, again, if you have a truck and your neighbor wants to borrow the truck and you trust your neighbor, I'm not telling you what to do with your personal assets, but you can't let a vehicle that's titled in your personal name have keys that are hanging on the hook inside of a recovery residence and just allow for the free use of that vehicle. That is a tremendous exposure for you personally. It's just not right for you because your name's on everything with that. Sell it. Sell it to the business for $1 if you're willing to part with it, and then insure it commercially, and then people can use it. That's the solution there. Any other big picture questions? Yep, one more.
The vehicle needs to be powered. Am I correct? Level 4.
Do they need to be? So my father always said, if you go to a barber, he's going to tell you need a haircut, right? Remember who you're talking to. I'm going to give you the insurance answer. If you are using a vehicle exclusively for business and controlled by the business and the business is maintaining it, it should be titled in the name of the business. It shouldn't be, and you should be insuring it that the vehicle registration card should have your business name on it. That way, any incident is isolated to the business operations and you keep yourself separate. That's back to the risk management stuff. That being said, even as a level 4 house, you can permit your house managers to drive their personal vehicles for business operations as long as you have that non-owned auto coverage. The reason it's called non-owned is because it's a vehicle that's being used by you that's not owned by you. But when it comes to drivers, just to circle back to your question also, when the vehicle is yours and you're the owner of the business, you can't give the keys away. But when it's a house manager and your job description, as Candace discussed, is written in a way that includes driving responsibilities, and they know they have to use their vehicle for the business and they're comfortable and confident in doing so, and the vehicle's maintained properly, et cetera, then they would be driving that vehicle. The owner of the vehicle is the only person that's to be driving the vehicle. That's like the short answer. Sorry if it took a long time to get to that. If the business owns the vehicle, then you can have your fleet of drivers operating it as long as they're scheduled on the policy. But if it's your house manager shouldn't be giving their keys to a dozen other people to drive it. Your house manager drives their own car. You as an owner of the vehicle drive their own car. If the business owns the car, then you have all of the employees who are scheduled to drive the car.
Each one has grab it, you will test specifically all of that coverage.
That's best practices, yeah. For two reasons. One, they need to be scheduled on the policy, likely because your insurance carrier has a driver limitation that says they need to be scheduled in order for coverage to apply. But two, it's your second fail-safe. Your first fail-safe is you should be running their motor vehicle report when you hire them and make sure that they meet your requirements and make sure they meet the insurance carrier's requirements so they don't skyrocket your insurance premium. And then the other one is once you send it to the insurance carrier and say, hey, I just hired 3 drivers, please add them to the policy, they might come back and say like, oh, driver 3, we can't add. We can't.
That's
Yeah.
Red should be or doing the
You're having residents drive vehicles? Yeah. I don't like calling anybody out up here. I have an issue with that from a risk management perspective. I don't believe residents should be driving vehicles unless you have some type of very specific nonprofit methodology that includes like vocational training where like driving is part of your program to help them evolve into a career where they would be driving for a living, like a carpenter or plumber or something, or a trade or something. That's a deeper conversation you need to have with your risk advisor. A general recovery residence for transportation purposes only, I'm anti-residence driving company-owned vehicles. Sorry, just from a risk perspective, it's out of control. Plus, if you're insured with a carrier who charges for drivers, it's going to be unaffordable. Your house managers are going to likely be over 21. They're likely going to have minimal or no major violations in the last 3 years, meaning their DUI is going to be 2.5, 3 years ago. A resident might have their DUI, DWI within the last 12 or 6 months. If you add them to a progressive policy, that's costing you like 11 grand to the policy just to add that driver. So just from that perspective, it becomes unaffordable. I call a house manager from my perspective, a house manager is someone that you can call in the middle of the night and rely on to fix a problem. Yeah. So someone, whether they graduated from your program and stuck around and live in the house, they're a senior resident, they're compensated, whatever. I call a house manager as what a staff member. Yeah. Any other ones? Tough ones? Weird ones? No? MAT housing is fine, transgender housing is fine, almost all types of recovery residence operation is fine. The only thing insurance carriers still don't seem to like is mixed gender residences that have common areas. You could have a duplex with a men's side and a women's side, but you can't have men and women in the same house that share the same kitchen and living room. That's the biggest no-no. Other than that, everything's good. Mic drop. Okay, thank you, everyone.